so now we will take a look at the last type of adjusting entries that we have. And this is the amortization of property, plant, and equipment and intangible assets. So property, plant, and equipment, often just called PP&E for short. These are identifiable, tangible capital assets. So those long-term assets like land, building, furniture, vehicles, and so on. So if you hear the term property, plant, and equipment, or capital assets, this is a general term talking about all of these types of items. So these land, building, furniture, they're all types of property, plant, and equipment. And then land, building, furniture, these are the specific account names that we're going to use to group the purchases that we have of these type of items. It also says here that these are tangible items. And tangible means you can see them and touch them. So you can see a building, you can touch it, and you know what the benefit is from that. Now this next point says that all tangible capital assets, except for land, will decline in usefulness as they age. So as you use a truck or equipment over the years, it becomes less useful. We've used some of the benefit from it, they're getting worn out. So this is actually an expense to the business every year. So as we use that benefit up, we have to record an expense in the company. You can think of it in the same way that supplies works. So when we buy supplies, we purchase it, it's sitting on a shelf waiting to be used. That is an asset because there's the future benefit, but we still have that waiting to be used. Once we use the supplies in running our business and it's gone, we've used up the benefit, that's when it becomes supplies expense. So it's the same idea for property, plant, and equipment. It's just now over several years. So each year we come up with an estimate how much benefit we're using and we record that as an expense. And this process is called amortization, as you can see here. So we're amortizing these capital assets. And the definition of amortization is the process of allocating the cost of PP&E less its residual value to an expense account over its estimated useful life. So we'll put that here. It's the process of allocating the cost of PP&E or intangible assets less the residual value to an expense account over its estimated useful life. So we look at the cost of a PP&E item, and we're going to put a portion of that into an expense account every year over the estimated useful life. So we're allocating that cost year over year. And reasonably, we can't know exactly how much benefit is used up year over year, so how much expense. So we're going to use methods that we estimate this. So it's not an exact science of, well, we got $10,000 worth of benefit, that's what we'll expense. We'll go through methods of how to do this. And then next it says down here that intangible assets are also amortized over the intangible assets' useful life. So examples of this are patents or trademarks. And this intangible means that you can't see or touch the benefit. So if we think about a patent, we have some sort of patent on a new idea for technology, that's great. There's definite benefit because it allows us the time to figure that out and sell it. But you can't really see or touch that benefit. It's more of a in the air, an idea of why you have that benefit. And that is why it's called intangible. Okay, so amortization, if we just quickly look at this definition again, the process of allocating the cost of PP&E or intangible less the residual value to an expense account over the item's estimated useful life. So two important parts there. So when we buy PP&E or an intangible asset, business needs to decide on two things. And the first one is that estimated useful life. How long do we think we will have that asset for and it will be useful? And then secondly is the residual value. Which is also an estimate. And the residual value means the value expected at the end of the useful life. So this could be 0. If there's no value left once you use up that asset, you might have a residual value of 0. But where there could be a residual value that is not 0 is, for example, some sort of equipment. Once you're done with it and it's used up, if you can sell it for scrap metal parts. So maybe you can sell it and just get a few $100s. Those few $100s would be the residual value. So we need to know these two items, and the accountant and someone in operations, they would talk and they would go through figuring these out based on the PP&E that they purchased. And once we know these, we're going to look at the first method of amortizing our assets. And for Chapter 3, the only method we're going to learn is called the straight line method. Once we get to Chapter 10, so right at the end of the course, we go through a bunch of other methods for amortizing or depreciation, but for right now, we're just going to learn the straight line method. And it says here depreciation, that is just another word for amortization. So they mean the same thing. You could use either. So for this chapter, the straight line formula that we will use to figure out how much amortization to record each year is equal to the cost minus the residual value and you divide that by the estimated useful life. So each year, we're going to have an even portion of the cost allocated into the expense account. Okay, so this is how we will figure out the dollar value. Now we need to look at the entries that we'll do. So we're going to have this new account that we're using in our amortization entries called accumulated amortization. And this is what's called a contra account. So contra accounts are a companion account, so they're linked directly to another account. And they have a normal balance that is opposite that of the companion account. So as I said, we will use accumulated amortization, and it is a contra account to our PP&E assets. So, for example, you would have an accumulated amortization account that goes with land. Not land. worst example, that's the only one I could say. Because we remember from this slide that land does not decrease in value. No matter how long you are on the land, it's still as useful as it is. So we don't amortize land. It's a good point, actually, that I said that. That is the one item in PP&E that we don't amortize. It continues to be just as useful, so it stays at that value. But equipment. So if we have some type of equipment, you would have an accumulated amortization for equipment. You would have accumulated amortization furniture. So it's a companion to these PP&E accounts. And accumulated amortization is used to show the cumulative sum of amortization expense from the date that we purchased the asset until right now. So we're going to use this when we record amortization. This is where that amount will sit. And the reason that we do this is because we actually don't want to change the value of the actual PP&E account. So if we buy a truck for $30,000 and we have that amount sitting in this vehicles account, we know that every year we use it, we're using up some of the benefit, the usefulness is going down, so we need to amortize it and record that expense. But the users of the financial statements will actually want to know what they originally paid for that. What did the business pay for that truck? So we do not want to just decrease the truck account when we allocate the amount to the expense. Instead, we're using this contra account, and it will offset the balance in the truck, and the overall net will show the new balance. So once we look at an example, this will make more sense. But to note here, accumulated amortization, it is shown on the balance sheet with PP&E. And it's noted up here, it has the normal balance opposite of the companion account. So our PP&E is an asset, its normal balance is a debit. So this accumulated amortization contra account has a normal balance of a credit. It has a normal credit balance. Okay, so we know what a contra account is. Now let's look at an example, and I think this will make a bit more sense. So we'll look at this. On May 3rd, 2019, HEC purchases furniture for $45,000 with an expected useful life of 5 years. So the journal entry, again, this is nothing new to record the purchase. This is what we did in Chapter 2. When we actually buy it, we will debit furniture and we'll credit cash. Just us recording that entry. And we know furniture will be a long-term asset because it has the useful life estimated at 5 years. Since that's more than 1 year, it becomes a long-term asset. So we would post that there into the furniture account. So that's nothing new. Now this next one is us at the end of the month recording amortization. So we know that as the asset is used each period, a portion of the cost needs to be recorded as this amortization expense. So after 1 month, in May, we need to book the amortization. Our debit here is as it says there, it's to this expense account. So we debit amortization expense. This is how much of the benefit we've used up in this month. And our credit is to this new contra account that we just discussed. So we will credit accumulated amortization. And we always need to specify with these accumulated amortization accounts which asset we're talking about. So we need to specify that this relates to furniture. So the expense account is okay to just put in one, but the accumulated amortization you need to specify. Okay, we've got our accounts. Now we need to figure out the dollar value to adjust. So we said the straight line formula is the cost minus residual value divided by the estimated useful life. Okay, so we know the cost of the asset from the previous slide. We paid $45,000 from it. For it. It doesn't tell us anything here or in this previous example about a residual value. So if it doesn't tell you one, then you just know the residual value is 0. And while we're here, we can see the expected life is 5 years. So it's just 45 minus 0. Clearly there's no usefulness after the useful life. And our estimated useful life is 5 years. So if we take this, $45,000 divided by 5 years equals $9,000 per year. So that's something to note here. When we divide by 5 years, this gets us our full year's worth of amortization. But we are recording this just for 1 month. So now we need to divide this by 12 months. And we get $750 per month. So that will be our debit and our credit amount. Important to be careful as you're going through these examples and know what period of time you're recording this for. So here it was for a month, therefore we need to find the monthly amount. If a question said that they do the statements quarterly, you would record this amortization every quarter, so you would be calculating 3 months worth. So just be careful of that as you're doing the questions. And another way that you could have done this is to say 45,000 minus 0, but now if we divide it by 60 months, which is 5 years, that also gets us $750 per month. So just another way to get there if that helps you as well. Okay, so we've booked this amortization, and here is what it looks like after posting to the TIA accounts. So we still have this full balance in the furniture account, and that's what we want, because the users want to be able to quickly look back and see what the original cost was. That is why we're not actually adjusting this account when we amortize. Instead, we've used our contra asset account. So these are linked to each other. And it's noted here that it's the accumulated amortization for furniture. And then we've got our expense for the amortization expense. And the textbook goes through and has them broken out, but we actually will just use one amortization expense account. You do need to specify with the accumulated which one it is, but not with the expense. So since we have the asset and the contra asset, we still want to know what's the overall net value of this asset, and that is called the book value. So this is equal to the asset's cost less accumulated amortization. So year over year over year, we'll continue to amortize this, and it will just keep getting added into this contra asset account. And we'll see what this book value is called, or what the amount is. And it's called the book value because it's the amount that's sitting on our books once we've amortized it. And it could also be called carrying value. And again, that's because it's the value that we're carrying it at in our accounting records. So the books are the accounting records, and that's what we're carrying it at. If we take a look at this here, our furniture we know is $45,000. We're subtracting or have less this accumulated amortization of $750. So we're left with a net amount of $44,250. And this is equal to the book value. So the net amount, or the amount we're carrying it on the books, is $44,250. So it's important to know the difference between the accumulated amortization and amortization expense. So the asset and the contra asset, these go on the balance sheet, whereas our expense will go on the income statement. It's important to know the difference between those. Okay, so this is how things would look on the balance sheet when we're showing our PP&E. There's two possible ways. So this first one is the more detailed manner, and it actually shows the furniture less the accumulated, and it gets us to that net book value. And then we see land here, and we know land is the only tangible capital asset not amortized. And that's because it has an unlimited estimated useful life. So we can't amortize it because it's going to last forever and have that value and usefulness to us. The second method here is just a less detailed version. So all it shows is furniture net, and it shows that book value that we've calculated. Now, we will use this top version in our class. We need to show this net amount, or show each individual amount and get to our net. If a company in the real world used this just furniture net bottom example, somewhere in the notes to the financial statement, they would break it out. So it would say, see note 3. And in note 3, if you looked further in the notes, it would show furniture, accumulated amortization, and net. So somewhere in the statements, you need to show all of this information. For our purposes, we're just going to do it this top way, as it is broken down right in the balance sheet. Okay, so that is amortization. I've posted another example for this in the practice section below the videos, so you can go ahead and try that now.